Synopsis just pulled off, well, one of the biggest acquisitions in tech history.
Oh, absolutely massive.
Right. We are talking about a $34.9 billion play. And it boosted their revenue to absolute record highs in 2025, but somehow they managed to crush their operating profits by hundreds of millions of dollars at the exact same time.
Yeah, it's a phenomenal corporate paradox to dig into.
Today, we are finding out exactly where that money went. Welcome to the Deep Dive. I'm your host, Jack, and I'm joined by our resident expert, Misha.
Great to be here. And, you know, when a company's top-line revenue surges like that, but the bottom line gets squeezed so hard, the financial forensics are usually hiding an incredible story.
And our mission today is to unpack that exact story using their 2025 Form 10-K. Synopsis is an absolute titan in the tech space, even if, it operates entirely behind the scenes.
Very much behind the scenes.
Yeah. So if you as a listener want to understand the modern world, like how we get faster smart devices, next-generation cars, or massive cloud servers, you really have to understand how this company operates.
Yeah.
We are going to look at what they actually sell, the peculiar way they monetize those products, and of course the financial aftermath of that huge acquisition of Ansys.
Right, but before we get to the profit squeeze, we really need to define the sandbox they play in.
For sure.
Which requires looking at the actual pipeline of how modern technology is built. They operate in a space called silicon to systems.
Right. So if you think about building a complex piece of technology, it's kind of like building a modern skyscraper. You don't just show up to an empty lot and start stacking bricks.
No, definitely not. You need architectural blueprints.
Exactly. And Synopsis provides the incredibly complex software used to design those blueprints for microchips. And they also provide the prefabricated steel beams, I guess you could say.
The standard structural components.
Right, so you don't have to forge them yourself.
Yeah, that's a perfect way to look at it. The software for those blueprints is what the industry calls electronic design automation, or EDA.
EDA.
Because modern microchips are packing literally billions of transistors onto a tiny sliver of silicon. The features on these chips are like a fraction of the width of a human hair.
Wow.
You cannot just draw that by hand or figure it out on a whiteboard anymore. Engineers rely entirely on this EDA software to design, test, and automate the creation of these chips.
Which makes sense.
And what we're seeing in the 2025 filing is a massive push into their Synopsis.ai suite. They are using artificial intelligence to optimize the chip design process itself.
Wait, so AI designing the chips?
Exactly. The AI searches through vast design spaces to find the most efficient architectural layouts much, much faster than a team of human engineers ever could.
That is wild. Okay, so that covers the blueprints. The prefabricated steel beams in that analogy, that would be their design IP segment, right?
Right. IP stands for intellectual property here. So if you are a company designing a cutting-edge chip for, say, a new smartphone, your engineering team needs to focus all their energy on the unique, special features that will make your chip outperform the competition.
Because that's what sells the phone.
Exactly. You do not want them spending months figuring out the underlying circuitry for like a standard USB port or a basic memory interface.
Oh, I see.
So Synopsis sells pre-verified, ready-to-use circuit designs for those standard functions. Customers just drop this design IP straight into their own chip designs.
That makes total sense.
Yeah, it drastically reduces their time to market and lowers the risk of the chip failing when it finally hits the manufacturing phase.
Okay, so they sell the design software and the prepackaged components. But that brings us to the $35 billion elephant in the room, the acquisition of Ansys.
Right, the big one.
Why did an EDA company, a company focused entirely on digital logic and code, need to spend $35 billion on a company that does physical simulation?
Well, because the sheer density of modern computing is basically hitting a physical limit.
What do you mean?
Before Ansys, Synopsis was focused on the digital brain of the device. But these chips have to live in the real physical world. And when you pack billions of transistors into a tiny space and run advanced AI models on them, they generate an enormous amount of heat.
No, right. Like a laptop overheating.
Exactly. But on a microscopic, intense scale. They experience structural stress. They emit electromagnetic fields that can actually interfere with their own internal signals.
Wow.
So you can no longer just design the logic of a chip. You have to simulate the physical reality of the environment it operates in.
So they essentially bought the laws of physics.
Pretty much. much.
They needed ANSYS to provide, like wind tunnel testing, fluid dynamics, structural stress analysis. So these hyperdense AI chips don't literally melt themselves or short-circuit in the real
Well,
world.
that is the core rationale, yeah. By bringing ANSYS in-house, Synopsys now owns the entire pipeline.
From the digital to the physical.
Right. From the microscopic digital logic all the way up to the macroscopic physical reality of the device. And this fundamentally changes their customer base, too.
House,
Well, historically, they sold their EDA and IP products heavily to a really concentrated group of massive semiconductor foundries and chip designers.
which honestly seems like a massive risk. Like looking at the 10K, one major customer accounted for over 12% of their total revenue in 2024.
It is a lot of eggs in one basket.
Yeah, if you have that much revenue tied to one single client, any delay on their end sends a massive shockwave through your entire balance sheet.
It's a very valid concern, and customer concentration is just a systemic risk in the semiconductor industry. But the ANSYS merger immediately dilutes that risk.
Because ANSYS brings in different types of clients.
Exactly. ANSYS brings in a massive portfolio of customers from high-tech, aerospace, defense, automotive, healthcare.
Oh, wow.
Yeah, if you are building a new commercial jet or a smart medical device, you need physical simulation software. So Synopsys is dramatically diversifying the foundation of their business beyond just the pure semiconductor players.
Okay, that gives us a really clear picture of what they sell and who they sell it to. But we need to look at how they actually monetize these products. Because selling hyper-complex engineering software isn't, like selling a consumer app on your phone.
Right. It operates on a very distinct business model.
Mm-hmm.
If you are going to understand the financial numbers we'll look at in a minute, you really have to grasp how they recognize revenue.
Lay it out for us.
Synopsys relies heavily on what they call technology subscription licenses, or TSLs.
PSLs, okay.
These are multi-year contracts, typically running for 2 to 3 years. But here's the kicker. They don't just take the cash and book it all on day one.
Because the transaction isn't actually finished on day one, right?
Exactly.
They are constantly pushing out software updates, security patches, and providing highly technical support for the entire duration of that 3-year contract.
Which means, from an accounting perspective, they recognize the revenue from those TSLs over time. It's a steady, predictable drip of revenue over the life of the contract.
Right.
However, they do have other segments that are recognized up front.
Like what?
Well, when they sell their massive physical emulation hardware systems, that revenue is recognized as soon as the hardware ships.
That makes sense. It's a physical product.
Right. The same goes for a large portion of their design IP products and many of the perpetual licenses that ANSYS traditionally sells. But the core EDA software, the lifeblood of the company, is recognized over time.
Let's put some numbers to that because the scale here is staggering.
Mm-hmm.
The filing shows a massive $11.4 billion backlog of contracted but unsatisfied performance obligations.
It's huge.
Yeah. That is $11.4 billion in future revenue that customers are legally locked in to pay. But Synopsys just hasn't recognized yet. And $2 billion of that backlog is sitting in something they call flexible spending accounts, or FSAs.
The FSA model is a brilliant piece of business strategy, honestly.
It's basically, well, it's like a customer opening a massive tab at a bar.
Yeah,
Like a tech giant commits to spending, say, hundreds of millions of dollars with Synopsys over the next 3 years. They are legally on the hook for that money, but they haven't actually ordered the specific drinks or, well, the software yet.
Right. They get to wait and choose which EDA tools they need as their specific chip projects evolve.
And if you're wondering why a tech company would want their revenue dripped out so slowly instead of cashing in immediately, look at the broader economy.
Yeah, this structure acts as an incredible financial shock absorber.
Because it insulates them from sudden macroeconomic panics. If interest rates spike tomorrow and tech companies suddenly slash their R&D budgets, Synopsys doesn't immediately crash.
Nope.
The revenue they are reporting this quarter is largely the result of sales efforts and contract signings from 2 or 3 years ago.
It gives them unparalleled visibility into their future cash flows, providing a level of stability that most tech companies would absolutely kill for.
But see, that shock absorber model brings us directly to the central mystery of the 2025 financial statement.
The profitability paradox.
Yes. We have this incredibly stable, high-margin business, bolstered by a $35 billion acquisition. In 2025, revenue crossed the $7 billion mark. That is a massive 15% jump from 2024.
A huge top-line win.
Right. Yet operating income actually plummeted. It dropped from over $1.3 billion in 2024 down to roughly $915 million in 2025.
Yeah.
So how do you generate almost $1 billion in new revenue, but watch your operating profits shrink by over $400 million?
It is the reality of swallowing a whale. The $7 billion revenue figure looks phenomenal, and it includes over $750 million brought in directly by the newly acquired Ansys.
Cooking.
But you have to factor in the immense cost of integrating a company of that size. The operating expenses ballooned from $3.5 billion in 2024 to $4.5 billion in 2025.
An extra $1 billion in expenses just to keep the operation running. Where does $1 billion go in a single year?
The vast majority of it goes to human capital. By absorbing Ansys, Synopsis grew its headcount by roughly 40%.
40%.
Yeah, they now have an employee base of about 28,000 people globally. When you add thousands of highly specialized, highly compensated engineers to your payroll, your employee-related costs skyrocket overnight.
I can imagine.
But beyond the sheer headcount, there is a massive accounting mechanism hitting their income statement: the amortization of acquired intangible assets.
Okay, this is one of those concepts that sounds like pure financial jargon, but it has a brutal impact on the bottom line. Let's break down the mechanics of that for the listener.
Sure. When you acquire a software company for $35 billion, you aren't just buying office chairs and servers.
Right.
You are buying their underlying code base, their patents, their customer relationships. Those are intangible assets. And accounting rules dictate that you cannot just hold those assets on your balance sheet forever at their purchase price.
You have to write them down.
Exactly. You have to slowly expense their value over their useful lifespan. In 2025, Synopsis saw a more than $200 million increase in this amortization expense alone. It sits right there in the cost of revenue, just dragging down the gross margin.
Not to mention the actual physical cost of executing a deal of that scale. The transaction costs alone, like paying the army of investment bankers, corporate lawyers, and integration consultants, that came out to a staggering $267 million.
It's incredible.
Wow.
And all of this cascades violently down the income statement. It's the primary reason net income for continuing operations dipped from $1.44 billion down to $1.33 billion.
Right.
And we haven't even touched the balance sheet restructuring yet.
Oh, yeah, the debt.
Right. To pull off a $35 billion deal, you have to leverage up. Their interest expense absolutely exploded. In 2024, they paid a very manageable $36 million in interest.
Okay.
In 2025, that number skyrocketed to almost $450 million, just in interest, because of the massive debt they took on.
So the short-term digestion process is incredibly painful, even if the long-term play is sound. But looking closely at the filing, the Ansys merger doesn't entirely explain the profit drop. There was another massive headwind in 2025 that had absolutely nothing to do with corporate acquisitions.
Right.
And everything to do with global geopolitics.
We have to turn our attention back to the design IP segment here, those prefabricated circuit components we discussed earlier.
Yeah.
In 2025, the adjusted operating income for the design IP segment kind of fell off a cliff. It dropped by 43%, tumbling from roughly $730 million down to $419 million.
That's a huge hit.
And the 10K explicitly links a major portion of this decline to actions taken by the Bureau of Industry and Security, or the BIS.
Which is an agency within the U.S. Department of Commerce.
Yeah.
And to be clear to you listening, we're strictly reporting what Synopsis stated in their financial filings here regarding the business impact.
Exactly. We are just looking at the math.
Right. The filing notes that in May of 2025, Synopsis received an is-informed letter from the BIS. This letter imposed strict new license requirements for exporting specific EDA software and technology to Chinese entities.
And the financial fallout from those restrictions was immediate. The data shows that if you exclude the new Ansys revenue, Synopsis saw its revenue in China decrease by 22% compared to the previous year.
And here is where the mechanics of their business model really come into focus. Why did a restriction on software exports hurt them so fast? Because we just established that their subscription model acts as a financial shock absorber.
Right, but the shock absorber only applies to the EDA software, which is recognized over time.
Oh, I see.
Remember, a significant portion of the design IP revenue is recognized up front. So when export restrictions suddenly disrupt customer projects in China, causing a drop in new chip design starts, it immediately hits that upfront IP revenue.
So the geopolitical situation didn't necessarily puncture their long-term subscription safety net, but it blew an immediate hole in their upfront cash-generating engine.
Exactly. The company also points to weaker than expected demand from a specific major foundry customer, along with some internal resource allocation decisions that didn't quite pan out. But the 10K makes it abundantly clear that these geopolitical export controls were a massive headwind directly impacting their bottom line.
It really highlights the vulnerability of deeply embedded tech infrastructure. Like you can have the most advanced AI optimization software in the world, but your balance sheet is still tethered to the reality of international trade policies.
Always.
So we have a clear view of the income statement now. We see the integration costs, the massive interest expenses, the geopolitical hurdles. But if you want to truly understand how a company survives a transformation of this magnitude, you have to follow the actual cash.
Always follow the
This,
cash.
right. Ansys cost nearly $35 billion.
Mm.
Even a wildly successful tech company doesn't just have $35 billion sitting in a checking account. How do they actually pay for this?
You have to look at the three distinct pillars of their 2025 cash flow statement to see the mechanics of the deal.
Let's break them down.
The first pillar is operating cash flow. This is the lifeblood of the company, the actual cash generated by their day-to-day business of selling software and IP. And surprisingly, despite the merger chaos and the geopolitical hits, the core engine remained remarkably healthy. They generated $1.51 billion in operating cash in 2025, which is an increase from the $1.4 billion they generated the year prior.
That's a great fundamental signal. The core business prints cash.
It does.
But $1.5 billion in cash generated doesn't come close to covering a $35 billion acquisition.
Yeah.
So where did the rest of the money come from?
That brings us to the second pillar, investing cash flow. This section of the financial statement shows the real shock to the system. Net cash used in investing activities was an eye-watering $15.88 billion.
Whoa.
Yeah. For context, in 2024, that same metric was a positive $1.2 billion.
And $15.8 billion outflow is almost entirely the cash portion of the Ansys deal, right?
Right.
Because I know a large part of the $35 billion purchase price was handled through stock issuance and assumed equity.
Right.
But they still had to hand over a mountain of raw cash to close the deal.
Correct. They paid approximately $16.5 billion in actual cash for Ansys. Which forces us into the third pillar, finance and cash flow. If your operations generate $1.5 billion and you need to spend $16.5 billion on an acquisition, you have to borrow the difference.
Right.
Financing cash flow provided a positive $13.35 billion in 2025.
And looking at the mechanics of that borrowing, they went straight to the debt markets in a massive way. They issued $10 billion in senior notes, which are essentially corporate bonds.
Yeah.
And they pulled down an additional $4.3 billion term loan. By October 2025, their total debt load sat at an astronomical $13.5 billion.
It is a textbook leverage play. You take on a massive mountain of debt to acquire a highly profitable, highly strategic asset.
With the hope that it pays off.
Exactly. The belief is that the combined powerhouse of Synopsis and Ansys will generate so much future free cash flow that paying down the debt over the next decade won't be an issue at all.
But the immediate consequence is a severe restriction on their financial flexibility. You can see it right in the filing. They explicitly suspended their stock repurchase program.
Yeah, that had to go.
Prior to this, they were authorized to buy back $1.5 billion in stock to reward their shareholders. They had to hit pause on that entirely just to ensure every spare dollar of cash flow could be routed towards servicing this new debt mountain.
They basically traded short-term shareholder rewards and a clean balance sheet for a monopoly on the future of hardware design.
It is a high-stakes, multi-billion-dollar bet on where technology is heading. And man, we have covered an immense amount of ground today.
We really have.
We looked at a company that fundamentally transformed itself in 2025. They bought Ansys to conquer the entire Silicon to Systems pipeline, recognizing that you can no longer design the brain of an AI chip without simulating the physical reality of heat and stress.
Right.
They drove massive top-line revenue growth, but swallowed heavy integration costs, massive new interest payments, and tough export restrictions that battered their upfront IP revenue.
The financial mechanics really tell a compelling story of a company in transition. But, looking beyond the balance sheet, there's a fascinating philosophical question lingering in the 10K.
Ooh, what's that?
Well, we talked about their Synopsis.ai suite and how they are using artificial intelligence to design better, more efficient microchips.
Right, the AI is doing the heavy lifting of the architectural layout.
Right. But think about the ultimate destination of those chips. They are the very silicon that will be used to train and run the next, even more powerful generation of AI models,
Oh, wow.
which will then be used by Synopsys software to design even more advanced chips.
It's a loop.
Exactly. We are essentially entering a closed-loop scenario where computing hardware is rapidly evolving itself. If the tools used to design the technology are becoming vastly smarter and faster than the human hands wielding them, what is the ultimate role of the human engineer in the next decade of development?
That is an incredible thought to end on. The tools are building the tools, and the grid is evolving on its own. Thanks for joining us on this deep dive. The next time you look at the tech landscape or just, pull your phone out of your pocket, remember the incredible complexity of the subterranean infrastructure making it all possible. We will catch you next time.